This is the season of year-enders and Outlook 2024. We have a spate of them, but we will pick the Axis Bank view as very important because the writer, Neelkanth Mishra, the chief economist at Axis Bank, is also a member of the Prime Minister's Economic Advisory Council. So that's an important voice to understand what's the outlook for 2024. Neelkanth, thank you very much indeed for joining us.
Thank you for having me here.
Well, it starts on a fairly optimistic note. And after you wrote your note on December 7th and said that you expect a 7% GDP, the Reserve Bank has followed suit, saying 7%. But what's your sense? Do you think we can do even better than 7?
I think we can. And remember that this 7% growth is on the back of fiscal tightening, meaning the government is sticking to its fiscal consolidation roadmap. This is happening on the back of monetary tightening. So interest rates have been jacked up. And as you know, they show up with, they have an impact with long and variable lags. We are seeing an incredibly tight liquidity condition. So there has been an effective 25-30 basis point hike just because the RBI is keeping liquidity very tight. And export of goods and services have slowed very sharply. So, and we are already seeing the impact of that in certain pockets of the economy. So the economy is doing very well. And I think that the medium-term growth projections, see what we like to call trend growth, those had been brought down meaningfully in the years before COVID as well. If you recall, 2011-12, we used to think about 8% inflation, 8% growth as a trend growth, and that had shrunk to 6.5-7% because of the slowdown that we saw 2015 onwards. And during COVID, there were economists who thought that the scarring from the pandemic and the economic slowdown would bring down trend growth even more. And I think what we are seeing now is, with the spate of positive surprises, a realization that the growth slowdown before 2019 was not very well understood. It was primarily a slowdown in the pace of capital formation. So as capital formation on the fronts of real estate as well as private corporate capex is starting to turn now, maybe it is now time to upgrade the trend growth assumptions. And that's why this growth surprise that we have seen is not really a surprise to us.
Okay. Well, I take your point on the growth numbers, but normally when you up the growth forecast so much, it invariably leads to inflation, at least a bit. The RBI has not upped its inflation forecast, and that puzzled me. Would you not worry that, logistics improvement has tamed core inflation across Asia and in India, but that is up to a point. Aggressive growth invariably leads to higher inflation.
Yeah, so that is why I started off with the discussion on trend growth. See, if you're upgrading your trend growth assumptions, you're just thinking that, okay, sorry, I was wrong. I thought that, or I didn't think so, and a lot of people thought so, that maybe India can only grow at 6.5%. And but if you think that India's potential growth is 7% or 7.5%, then upgrading is just a reflection of the fact that the economy was slated to grow higher and is growing. And so that can be non-inflationary. But there are other aspects to this, right? So the first aspect is that that we are still 1.2 years, 1.3 years below what was our pre-pandemic path. So even if you think that 6.6% is the trend growth, which was average between 2011 and 19, then versus the pre-pandemic path, we are still about 1.3 years behind. And which means that there is a lot of spare capacity in the economy which needs to be filled up on the labor side, on the capex side. The second aspect, which I think is a reason why core inflation should remain well behaved, is that there's no fiscal or monetary juicing which is happening. We're actually seeing fiscal consolidation and monetary consolidation.
Okay, let me latch on to that point. We are speaking about fiscal consolidation only in terms of a delta. That from 6.9%, we came down to 6.5, and now we have come to 5.9. But inherently near 6% central plus 3% states is a 9% fiscal deficit. Yes, we have had 4 years of 7%, 9.1, 7.2, 7%, and maybe 6.5 next year. But that's also because the economy is moving on steroids. In any other previous decade, we would consider 6% fiscal deficit plus 3% very high. If that is brought down, do you think growth can still be as good?
Yes, because see, we are looking at incremental trends, right? So if you think about inflation, so if there was an inflationary impact, and I think there is an inflationary impact of having 5.9 plus say 2.6, 2.7% state. So say 8.5% fiscal deficit consolidated. If there is an inflationary impact, if the next year that 8.5 becomes 8, there will be less of an inflationary impact. So that's the point I'm making, that incrementally, which is why the pace or rather the direction of fiscal deficits is perhaps equally important when we are looking at the impact on core inflation. So the consolidation path that the government is showing, and I'm hoping it sticks to, and I expect it to stick to it, that is very important when we're thinking about core inflation projections.
Okay. If you remember, from FY11 to FY12, the government brought down its fiscal deficit very sharply because fiscal deficit was very high from 2008 to 2011, obviously because we were trying to answer to Lehman crisis, and suddenly realized that this is not our crisis, and we brought down. As we brought down the fiscal deficit by about 90 basis over 1 year, GDP fell by 300 basis points in that year. Of course, there were other reasons, but fiscal consolidation will have its impact on growth in the coming years as well?
Well, you have to see things in their entirety. So if you go back to that era, the fiscal consolidation, the problem with the fiscal deficit in India was actually the pay commission changes. The more discretionary impact, or rather the short-term stimulus from, say, reduction of excise duty on autos and all that, could be reversed back very quickly. The biggest problem India faced at that time was that we gave a 80 to 100% hike to every government employee, and wage bills for state and central governments went up by 2.5% of GDP. How do you do that consolidation? And that meant that all of your spending was unproductive, and that led to a significant increase in the current account deficit. Therefore, we were on the other side of the taper tantrum. We were depleting reserves. And remember that the excesses of the private capex side, right? So remember 2007-8, we had 120, 130 gigawatts of power capacity. And at one point, we were constructing 200 gigawatts of thermal power capacity. In steel, we had 45 million tons of steel capacity. We were adding 60 million tons of steel capacity. Now, those cycles also turned. If you remember, I mean, in my early house, we wrote The House of Dead.
Yes.
And all of those, 8 out of those 10 companies are no longer there. So there was a large period, there was a significant consolidation on the private side, which then coincided with the irrational fiscal expansion that had happened and the consolidation of that. Okay. And therefore, the growth deceleration was quite sharp. And remember that this time, this is why the government is bringing it down in a gradual fashion. Okay. Because if your debt to GDP is elevated, if you try to consolidate too fast, you can very quickly get caught in a debt spiral. Okay. And therefore, it is important to reduce it by 50, 70 basis points a year, not by 100 basis points a year.
Well, I have a nagging fear that both in the US and in India, it is the steroids of fiscal deficit which could be accounting for part of the higher than expected GDP. But, well, let me get to the other more interesting parts. Your potential growth expectation of, 7% for the rest of the decade for India, would you worry about, other issues like the whole geopolitical churn, which is making every country raise tariff barriers? So, overall productivity of the global economy goes down. Or for that matter, AI and the churn that it is creating, supply chains getting disrupted. Would all this mean that global growth and hence India growth will not reach the kind of highs it reached in the first decade of the current century?
Very important questions, all of them, right? So let me first address the fear that you mentioned before you got into the question on whether the fiscal support is what keeping the economy supported. And in the US, that is correct, because remember, this is what economic theory says. If your fiscal deficit is rising, it supports GDP. If it is high but flat, has no impact on GDP growth. If it is shrinking, it is a drag on GDP growth. This is where US and India are on totally opposite sides. So the US GDP growth has been supported by a near doubling of fiscal deficit. So 1 trillion went to $2 trillion. We've discussed it on your show as well. In India, we are reducing our fiscal deficit. So the fiscal is a headwind in India. And so the growth surprises that we are seeing is despite a reduction in the fiscal deficit. Remember that when you're thinking of growth, the level of fiscal deficit does not matter. We need to bring it down. But as of now, I think it is a negative impact on GDP growth. Now, coming to the questions on, I think the trade barriers, the impact of AI, I think all are extremely important questions. Remember that AI is being seen as a growth booster because it will improve productivity. And I also think so. And therefore, when I think of AI, I think of it as something that, for example, it has been found that call centers which use AI productively can bring down the duration of calls from 9 minutes to 4 minutes. Now, instead of just thinking about what that means in terms of the number of call center operators that you need, think about all the additional problems that can be addressed. Fact that all these long waiting time, people getting frustrated. Now most Indian banks have voice IVR. So I think productivity boost is going to be supported. So I think AI is going to be supportive of higher growth and not take away from it. Trade barriers, yes. I think global productivity, I think global issues will get affected. I think that's something that policymakers globally need to worry about. When I think about India and look at TFP growth, and I'm glad you brought it up, because when I think about 7% growth, I'm looking at 1% growth in labor input, 2% growth in TFP growth, the total factor productivity, and about 4% growth in capital formation. And the 2%, remember that between 2014 and 19, India's TFP growth was 2.4% a year. So 2% would be even conservative. And if you split it between agriculture, industry, and services, agriculture industry TFP growth, the last studies were done in India specifically many years back, but I would think that those trends can still apply. It is unlikely to be more than 1% a year. The reason why India's aggregate TFP growth is, and this is something we address in our report as well, the aggregate TFP growth is so strong is because of our productivity growth in services. And that has several domestic factors. So, for example, a very large part of our services GDP is retail trade. So as the 20% growth in modern trade now starts to become bigger in terms of percentages of the overall trade, meaning, if you're growing at 20% and you are at 0.5% share, it does not really move the needle, right? But when you're at 4 or 5%, 20% growth means that the productivity growth is much higher. E-commerce expansion, or in financial services, or the automation of construction. So many services, I think for domestic reasons, are starting to move their productivity frontiers. The second aspect is modern trade, and we have written about it. Modern export of modern services. That if you start providing these services to the rest of the world, and the rest of the world starts moving a lot of this know-how to India, over a period of time, this diffuses into Indian company behavior as well. So I would think that the trade barrier on the good side will perhaps keep productivity improvement limited. Perhaps that's an if. I don't think it's a given what's happening on electronics and how quickly we are starting to get much bigger in the electronics ecosystem. But I think that on the services side, where I don't see as much of friction yet. I mean, whatever friction is there is very high, but it's not increasing. I would say that I don't see that risk to TFP coming through because of global issues.
Thank you for watching us on CNBC TV18. For all news and updates, subscribe to our YouTube channel and watch us on all social media platforms.